Welcome, everyone. It's Angelo Robles, founder and CEO at Family Office Association and host of the Angelo Robles podcast. I figured I'd change things around a little bit today. You all have been saying, of all the things that I could get text, emails, and messaging on, you think it would be, questions, ask better questions, here's some guest ideas. It's usually about how come you're almost always wearing a black shirt. So I figured I'd wear a white shirt today. Maybe I'll begin to mix it up a little bit more. I do have a rotation of 11 black shirts, but you are correct. I do need to change the optics a little bit. So today, bank CEO on the future of banking, including central bank digital currency known as CBDC, crypto, DeFi, staking in DeFi, cannabis, and more. It features Ryan James, CEO of Surety Bank. His bank CEO career started with him being the youngest in Florida, and still to this day, over a decade later, one of the youngest. He's led through trying times while diversifying revenue streams into banking, cryptocurrencies, ATMs, and the cannabis industry. So we have a lot to discuss. Ryan, welcome to the show.
Thank you for having me, Angelo. It's great to be here.
Well, I have a lot of questions for you, so why don't we get right to it? In 2009, you became the youngest CEO of a bank in Florida. One, how old were you? And two, how did you become the CEO?
Well, I just turned 30 years old, so I became CEO at 30. Prior to that, I started at Surety Bank in 2001 out of college. Small little bank, only about 65 million in assets. And the CFO at the time, which they called the cashier, had a heart attack. So they're like, you have a finance degree, and threw me in that role. So after about 6 months of postgraduate in high school, I'm in college, had nothing to do, no idea anything about banking. I was preparing the financial quarterly reports for the federal government. So that was my foray into banking back in 2000. And so I, did that aspect for many years for Surety Bank, but then moved into commercial lending. And so that's where I saw, where Surety Bank was making primarily the most income was from commercial lending. So I honed in my commercial lending skills. And then from there became executive vice president and then CEO in 2009.
2009 would be towards the end of, I guess you could call it the crisis, the banking crisis. So interesting times. You were thrown into the mix, into the fire. How did you, at such a young age, without deep experiences working in other companies or starting organizations, how do you observe, learn, make decisions, and become a leader during such trying times?
So in 2009, we're in essence a community bank. With commercial loans as our biggest portfolio at that time. It hadn't quite come down yet. You had residential loans that were collapsing, but it didn't really hit the commercial sector just yet. And so when I became CEO, my number one focus was to grow the bank, increase the marketing efforts, and really grow. But within 2 months of becoming CEO, I got a call from the FDIC, our insurer, and they noticed that we had some late loans on our call report. So they came down and 2-day visit, they charged off 20% of my capital. So that immediately diverted all of my attention. So from growth, it went directly to, we have to look at our assets, we have to work out these loans and go from there. And, at that point, I didn't know what I didn't know. And I was extremely overwhelmed and went to a banking association forum for CEOs and directors. And in the meeting, they were asking a couple of questions of what are banks doing when you identify a troubled loan? They call them adversely classified assets. And how do you analyze it? How do you charge off? What ratings? And so I answered the question. Now, this time I was 30 years old. By far the youngest in the room, probably by about 30, 40 years of age. I mean, I stuck out like a sore thumb. But I answered the question, and they looked at me like, okay, you know how to write down an adversely classified loan. And then they had another question. Nobody in the audience answered it. And so I answered it, and they looked at me, asked who I was. And so from that point, I realized all the bank CEOs were so far removed from doing any type of real banking. They were in such a high trajectory that they did not know how to work out loans. So
Yep.
immediately there, I left and said, you know what, this is a complete waste of time. We know what we're doing. And so that there kind of gave me the confidence that, okay, I didn't have the traditional CEO in front of me that was guiding me, but I knew my customers, I knew how to work out loans, and we looked at what was going to be best for our customers and for Surety Bank.
Yeah, I mean, I look at, I wouldn't say your lack of experience and your age as being a detriment, although sometimes with age does come coolness under pressure and experiences that can be good and can relate. But I potentially look at your situation as being potentially a positive. You had a different mindset. You weren't entrenched in a way of thinking, and you were completely immersed in this opportunity that came to you that you earned also along the way. And you knew this was not something that you may get a second chance at. You were completely dedicated to making it work. You didn't have your own personal net worth, what it would potentially eventually become. You needed to make this happen. So this is somewhat like an entrepreneurial endeavor. True or false? The biggest threat to community banks is thinking small. A little bit of context. I would define that as 1 to 10 branches. Like, do you move? What happens if a customer moves? It's a community bank. You may lose that customer. Do you build organically or inorganically through purchases? And how do you do as such? How do you potentially, not that you've done it yet, but how do you potentially become a regional bank? But I am jumping the gun. Why don't we start with, is thinking small a challenge in community banks?
Well, in banking in general, it's the saying, we've always done it these ways, so they just are stuck in the same way time and time again. The average community bank, when they were starting in 2000, they were really starting raising capital, and they had an exit strategy to sell in 5 to 10 years, 2.5, 3 times book. That's what all their plan was. We were different as, no, we like being a community bank. We're looking for return on investment for our shareholders. We weren't looking at a 5-year strategy to sell. So they were just growing as quickly as possible. So a lot of banks really got hurt in that 2009 because they grew so fast and they were decimated and got shut down. But I look at community completely different. It's not bound by geography. So, it's bound by shared interests. So we have our community local as far as commercial lending, but then we have our community as the cryptocurrency community, the non-bank financial institutions, the check cashers, they're our community, and that is evolved around the whole nation. So even though we don't have a physical branch around the country, it is with technology very easy to support businesses throughout the nation. So we don't have to have that extra expense of staffing locations throughout the country. It's a little bit different, but when it just makes sense. You don't have to, it's very expensive to staff a branch. A minimum branch need at least 5 employees. You're going to spend $250,000 a year just on the basic staffing it before you ever even open the doors.
For sure. Do you see the vision with you and the board as, and nothing wrong with it, it might even be the preferred strategy of inorganic growth through strategic purchases? And again, that is going to take money. Irony, of course, you're a bank, but still, that might even require outside investors. Is that something that you looked at and potentially are going to be doing sooner rather than later?
So we have enough capital right now to continue our growth strategy. And from there, we can always look at our existing shareholders. I was lucky enough in 2009 when we did raise capital, we were able to raise capital at book value. I believe we were the only bank in Florida at that time to raise money at book value. So none of our shareholders that didn't buy in, they weren't liquidated. It just didn't decimate their stock. So we have a very good, strong base. And if we were to raise capital, we would look at our existing shareholders. We're subchapter S. So typically we're paying out at least 60% of our net income to our shareholders annually, but we're able to retain enough to grow. And we've bought a lot of tax-free securities, and the income from that has enabled us to grow too. But there's other ways that, you can create a holding company, get some debt at the holding company level and downstream it, for growth, as opposed to raising capital and have and having somebody else have another seat at the table. And as for my board of directors, it was completely different from them, but as they were seeing the returns and costs, they quickly jumped on board with our model. And we've been doing it now for a decade.
And yes, I know my audience is probably wondering, Angelo, are you going to get to the dynamics of fintech, US regulation, what China's doing, central bank digital currencies, crypto? All of that is coming. I think it's important to lay a bit of a foundation, but trust me, Angelo's crazy stuff, although maybe not so crazy anymore, is on its way. You said a couple of interesting things. First of all, a little bit of, I wouldn't quite say luck, but you are in Florida. I'm in Greater Connecticut, New York City area. We're potentially losing during COVID. You're gaining a populace that appears to be going to Florida for a variety of advantages, what they may deem to be regulation, COVID, or less so restrictions, no state tax, weather, whatever it may be. It's obviously a state, along with Texas, Tennessee, and some others, it appears to be, quote unquote, on the rise. So more people going there. For sure, you said something very interesting with banks being, well, a little older, and this is how it's always done. That line of thinking, especially now, and with some of the questions I'm going to get to, which will play out more in the relatively short years to come, is going to be a complete upside down for many of these organizations, in my opinion. And I'm wrong a lot, so maybe I'll be wrong again. We'll see. What is the biggest change since you took over as CEO about 12 years ago that you've seen in your industry and community, the single biggest one?
So regulations have really enhanced. But if I could have wanted to go back, you had talked about biggest threat to community banks. And there's a really huge threat that a lot of banks don't even talk about, and that is the core software that banks have. Since we're not large enough to create our own software like Bank of America and Chase, we have to rely on vendors for our core software that holds all of our customers' data. And there's some legacy cores that have been out there. And to me, they're the largest threat to community banks. Their contracts are 7 and 8 years long, and they charge per items. So, when I became CEO in 2009 and wanted to grow customers, at that time, we didn't even have online banking. So the first was get online banking. Well, the cost of an account back in 2001 was not very much. And it was very common for people to pay $5 for a monthly checking account if they dropped below $2,500. Well, nowadays that's gone away, but the cost that banks have for each account has gone up nearly tenfold, because since we don't have the technology for online banking, you add that was adding on nearly $1.85 per account. So every consumer that logged on for online banking, it was a cost of $1.85, regardless if they ever used it. Just the fact they had access, and then the mobile and added. So it was costing us nearly $7.50 per account just to house on our system.
Yeah.
So the average consumer does not have enough balances in their checking account to even cover that cost. So I looked at this and was like, coming out of the recession was, wow, I want more customers, but more customers will do the opposite effect, will go bankrupt. And I'm like, well, is it just me? Do I have the wrong pricing? And so I looked around and then found out that 99% of bank CEOs had no idea what even their cost per account was. All they looked at was their net interest margin. That's it. But there's a lot that plays into your costs. So I pulled the trigger back in 2018 and left the legacy cores, which a lot of people were afraid of. Left that, went to the cloud ahead of time, and was able to get my pricing down and to put it in place to where we wanted to go. And I'll give you an example. For us to do nationally, check imaging, obviously post 2001 became the mainstay. But with the legacy cores initially want to charge just for an image of a check, my first quote I got was like 30 cents. We're doing over 200,000 electronic checks a month. So imagine paying that much just for an image, even though it wasn't increasing their costs. But banks and billion asset banks, they just continue dealing with the legacy cores and not telling them to innovate. And anytime they want to add on innovation, they get charged an arm and a leg, and it takes them 6 months to a year to even integrate. And when they do, there's still so much back office work that they have to do. So that was kind of the biggest change. So 2009, got to have another income stream than just commercial lending and fund it by CDs because we were a one-legged stool. And then second, I have to do something about our core technology. I've got to have something that the price goes up when we make money, that we're in it together, not get nickel and dimed.
Yeah, you were well ahead of the curve in terms of going to the cloud. We will get to some cybersecurity concerns, and that's going to be likely a major threat for fintech, financial institutions, and banks moving forward. A lot of interesting nation states and talented hackers out there. We will jump into that a little bit later. Let's talk a little bit about kind of the nuts and bolts of effectively how banks make money. And I do want to give a little shout out to Ryan for a second. Most bank senior leaders, let alone a bank CEO like him, do not like these kind of questions. And especially the kind of questions I have coming up, 9 out of 10 times, instantly their internal teams or PR would instantly reject. To Ryan's credit, he encourages them, didn't even want to list the questions beforehand because he has confidence in being natural in terms of answering questions. And if something is not applicable or he needs to be a little more muted, he'll simply say so. And there's nothing wrong with that, but at least we get to ask them. So let's get a little bit of insight. In a low interest rate environment, the broad question, how do banks make money? As you elaborate, you could get pretty deep. I'd like to learn about residential mortgages. Do you warehouse? Are they sold out to Fannie Mae? You mentioned earlier commercial lending. And I think my audience, even though I think they're smart investors, aren't really clear like the mechanics of how banks work. When you're paying near 0% in savings and checking, yet there still is, I'm assuming, millions and millions of dollars in your bank, that is then repurposed into lending, which could make a hell of a lot more than 0%. So talk us through, as much as you're allowed to say, a little bit of the mechanics, and I'm not even factoring in late charges, ATM fees, credit cards. So tell us some of the secrets. How do banks make money?
Okay, so like I said, Surety Bank, we're 200 million in assets, roughly. I think as of today, we're 185 million. So in the grand scheme of things, we are very small. The top 4 banks are nearly like 60% of the total deposits in the nation.
Right.
So, but there's 4,000 banks in the United States. It was 10,000 when I started 20 years ago, but now we're at 4,000. So I know my world. And so traditionally what a community bank made money on was commercial lending over the last 20 years. And those were the loans that we portfolio and we keep in house. Now those loans typically rates fixed for 5 years up to 10 years, maybe a balloon at 5, or after 5 years, you're going to tier with typically prime rate. Now, residential loans, it used to be you'd be able to portfolio those, but post-crisis, there's so much scrutiny that unless we are doing it in mass volume, there's many banks even billion size, you let either mortgage brokers do that or it's pushed to the side. So we make very little to no money off of residential loans because we have to do it in such a volume to even get that price. So, but typically, yes, you take in deposits and you loan it out. Our deposits are liabilities, they're IOUs. We owe that to the customer. And then we loan out, whether in commercial real estate or buy bonds. That's another aspect. They have to be bank qualified bonds. Banks can't go out and just buy, stocks on the New York Stock Exchange. We are regulated and watched. They want us to be, safe and, not overcommit in certain sectors and to diversify not only within bonds, but within loans, commercial real estate, whether it's owner occupied, non-owner occupied. That is the traditional model for community banks. But during that time, you can make fees on, deposit accounts, larger accounts, whether it's an account that does a high volume of ACH transactions, there's going to be fees associated to that. We have become experts and we bank the check cashing industry. There's, nearly 20 to 25% of people are still unbanked or underbanked. And, they are in the communities, whether they're outside gas stations in rural areas, they need banking services. So we provide those banking services to them and charge a fee. So now our shift, a lot of our fees now come from our deposit services. So we have our loans and we have our deposit services, and that has been, extremely successful for us.
And in terms of things, I mean, I guess things like the spread between savings and checking versus commercial loans, what is that known as, a net interest margin?
Correct.
But like you said, and do you warehouse, do you sell them out? From what I hear, even the biggest banks, residential mortgages are very far from a profit center, but they're an engagement with a client for other services. How about small business loans, or is that all basically done through the SBA? And again, from a profit perspective, it's negligible.
And as well, we do some SBA loans, and you're able to make some fees off of that. And
Sure.
the second is a sell, you're able to get a little higher rate on the first because you're looking at a blended rate between the first and the second, and that has been very well. Small business loans, even equipment loans, those are the areas that you're able to help your community where the big bank won't touch. The one thing that I really like about being small and nimble is we look at it and see if it makes sense. A big bank may just take paint with a wide brush and say, you know what, offices from this pandemic are going to be destroyed, so therefore we're not going to do any office loans. So, in that case, that may be room for us to take, because there's plenty of people that have been in offices, they've had 20 years of history, they make good money, and they just want to refinance their office place. So there's always different areas to do that. But yes, the typical rule of thumb for banks was having a 4-point spread, that you wanted the deposits in that. Now, what I'm seeing is some of the larger regional banks, they're loaning 2.75% fixed for 10 years on a 25-year amortization. So they've got a long amortization. They're not getting as much up front to reinvest each year. So I see that. I don't know how they're making money, because when we get audited by the FDIC, they look at their CAMELS rating, capital, asset quality, management, earnings, liquidity, and sensitivity. Well, right there's a sensitivity. If you're locking in 2.7 years for 10 years, I guarantee you nobody's buying a 10-year CD at those banks. So what's going on there? What's going to happen to them in a rising rate environment? Even 50 basis points could decimate that portfolio. And to me, if I'm lending out, it doesn't matter how strong that customer is. At 2.75 for 10 years, the worst thing that person going to do is make his payment to me. We're just not going to chase that. We're going to stay liquid. I saw that prior to 2009. Bankers were saying, well, if I don't make this loan, the other bank's going to. Well, go for it. I mean, that's why a lot of those banks are gone. We just can't chase those rates. We can't fall into it. So our loan to deposit ratio is below 50%, and we're fine with that at this time, because things change. We're going to be in position to, loan when all the other banks aren't. And some of the best loans and yields that I remember doing was in 2009 and 2010, because the real estate values had decreased in Florida, some 25, 30, 40%. The yields were still good. And, buyers need to not always focus on your loan rate. You need to also look at what you're paying for that property. It's both of them combined, and whether or not you want to make that deal.
And in terms of credit cards, do you originate on your own? Is it profitable? Is it simply outsourced?
For a small bank, it is not profitable at all. You partner with a larger bank, brand your name. I mean, we cannot offer the benefits, the 1.5% chargeback.
Right.
We're not the issuer, the sponsor, we're not handling that. So it's just not feasible to do it. So if we're going to offer a product, it needs to be the best product. So
we always hear from the giant banks, they probably don't want us to know, but it's public information about how profitable like late fees are and things like that.
Oh, absolutely.
And how does that play into a small community bank?
We don't like making money off of return deposit items. And it does have a physical, you have to make a decision and return those items. You don't want the phone call back from the customer being mad. So that's not where we want to make money off of, or bounce checks. That's just not our MO where we want to do that. It ends up creating more work than not. So yeah, big banks really do. And that's kind of like the fallacy. When we got into banking check cashers, the reason they existed was because really the big banks are the world's largest check cashers. If I write you a check to Bank of America and you don't have a Bank of America account, they're going to charge you to cash that check at the bank. I don't know what fee, depends on what region, but a lot of times that fee is way more than that check casher is going to charge that customer. So that whole industry was villainized when it was created from bad regulations from the big banks, and there was a need in the community. So that's why those check cashers and the payday lenders existed to begin with.
Does your community bank offer any investment and insurance services, probably through an internal RIA?
No, we don't.
Okay. What are the pros and cons of a consumer using a community bank over a national or even a regional bank?
Oh, it's flat out simple. Service. If you look at your statement, you look at online banking, and you see a charge that you didn't do, you can rest assured we got on that. Just 15 minutes ago, I have a commercial checking account, a landscaper. He noticed 2 checks, fraudulent checks hit a total of $15,000. He's not going to have to wait on the phone for hours to commit his space. Signs the affidavit, we're going to return that immediately, and he's going to get credited to his account, and that depository and bank's going to end up having to fund that. That's the biggest thing. I will open up accounts at large banks just to see, and if you have any dispute, you're going to be on the phone for hours and may never even speak to someone.
COVID has created somewhat of what I would call a no-pay culture. I'm assuming this is going to impact on residential, which will have less impact on you. You're not warehousing, it's done with Fannie Mae, but may have an impact on some personal and business lending that you guys do. What is the no pay rate during COVID? I'm assuming it's worse than prior. And is it starting to get better, or if anything, it's getting worse?
Well, you mentioned, in Florida, we're not seeing it like you're in Connecticut or elsewhere. So a lot of the businesses are doing well. You had restaurants that were really hurt last year. We see them really coming back right now and coming through there. And so when I look at our portfolio as government assistance winds down, I don't see, I think all of our customers are going to be fine. They've made it through it, and they'll be good for our commercial loans. So I don't see any bad loans in the mix. The only ones that may come about were going to happen regardless of the economy.
How much of a threat to community banks are the following? Increased regulatory pressure, increased capital demands, technology platforms and innovations like Square and PayPal.
Okay, regulatory is always going to be up there. And, that's the thing. When we get audited, at time now, the last audits have been remotely, but I'll have more examiners than I have staff at some point. I have 16 people in here, and they all want to make a name for themselves. So when they're looking at our loans, they may look at 50%, to where I can't imagine they go to a large bank, they're going to be looking at 50% dollar-wise of their loans. But, with the regulatory, as long as they follow guidelines, I'm fine with the regulatory environment. There should be that oversight. What I don't like is when you get a regulator that comes in and like cherry picks different things and doesn't look at the whole. But, we're funny. Even if we have great ratings and they may have one little minor issue, I will fight tooth and nail on that issue if I believe in it and put them to the test. And they're going to have to show me, did we violate it? Where is it exactly in the regulation? I don't want your interpretation. You're going to have to back this up, because ultimately we don't want any findings. We want to, go through everything and have a clean bill of health. The Squares of the world, I don't find them a threat to me, but because regulators scare the crap out of community banks and banks to not be innovative. They really hold us
for
to
sure
a higher power than they do Square. It is absolutely ridiculous. When they come in, they want to say, well, what new products have you started since the last exam? And they come in and want to be Monday morning quarterback, and I'll get sick. They'll ask you 15 questions when it's like, listen, you're asking leading questions. Will you just ask the real question you want? We will be transparent with you. So it's like they always want to play gotcha, as opposed to, no, we're trying to do the right thing. Let's walk through this, because even when we come up with a new product and we tell the regulators ahead of time, they won't say yes. They just will say, we don't see anything wrong with it. They never give you advice. It's ridiculous. So they'll say they're there for help, but they don't. And so what they've done is they've made it where it's easy for banks to say, you know what, we're not going to be the merchant. We're not going to offer the credit card service and merchant opposite, but we're going to bank the customer that does, because then all we have to do is see that they have a plan, that they are being audited. So they've just really scared banks from being innovative.
For sure. And that's a subject that we're going to somewhat jump into when we talk about what's going on in China and some newer developments, and how, my opinion, we are way behind. And I don't know if we're really ever going to be able to catch up, but maybe we'll jump a little bit into that shortly. Related to that question, I even think of a platform like Voyager, where you could buy and lend against whatever cryptocurrencies. And I could buy Bitcoin, something that everyone would know, and I could start to get whatever, 4 or 5% on it. Months ago, it was probably closer to 8 or 9%. How are bank savings and checking accounts paying nothing, losing net negative of inflation and taxes? How could you keep up with that?
Every exchange and every fintech has to bank somewhere. So ultimately, when the Bitcoin, when it goes back to US dollar, that ends up touching a financial institution. So it's just more money movement around. And so, it's not doing away with the banking world. Now, money may not be residing on the deposits of the large banks, but we have not seen an issue with lack of deposits on our end. We've had, way more liquidity now than we know what to do with.
Well, it's a good problem. I believe in the upcoming years, I'm going to call it ballpark about 5, that central bank digital currencies, which are completely centralized, very different than Bitcoin and most cryptocurrencies, will give the government tremendous insight, tremendous control. They're arguably, central banks, the most powerful entities in the world right now, that will go up a multifold once, inevitably, globally. There's just no way around it. There will be a lot of central bank digital currencies. My question to you from a banking side, and they're still kind of figuring this out in China, this could go one of two ways. It could go the governments and central banks going direct to the consumer, which will give them even more control. But boy, that's going to be a lot of service and complexities. Or they don't want to crush the existing financial system. They want banks to survive. And although this is inevitable, I think it's very hard to argue against it. The banks like yours may arguably be a middleman in this and still kind of be the servicing arm. And to some degree, not much may really change from that perspective. What do you think?
So it's probably a little bit of both, but you're all right. We are kind of the middleman, and to where we position ourselves is, if I'm not going to bank cryptocurrency, where position Surety Bank is, we are experts in anti-money laundering. So when we started banking check cashers 20 years ago, it was small little convenience stores, and we were seeing that banks were de-risking and getting rid of that industry. So I was looking at, well, why are they doing that? When I found out they were doing that because they weren't willing to understand their business. And so I went in there, understood their business, and saw what I could do to grow that. So in doing that, post 9/11 and post this, in essence, banks are big brothers. We're having to watch accounts. We're having to have our pillars for BSA, have our internal policies or controls. We have to know our customer. And as you see, that's what they're even going to the exchanges and the Coinbase. Like, Coinbase has to know their customer. As transactions are increasing the volume, they're going to be going to the exchanges and saying, did you identify who this person is? They're going to want to be able to forensically track information. And so, Bitcoin is not completely anonymous. You're putting transactions out there on the public ledger system. So it's a lot easier to track the movement than it is traditional cash. So, that's where we position ourselves, is we're a boutique bank that are experts in money laundering.
That's an interesting perspective. And you're correct. I guess if I was a bad guy, using cash while we still can is effectively kind of the way to go. Do you agree that it's inevitable, and I don't mean 20, 30 years out, that here in the US that we will have central bank digital currencies, and when?
Yeah, I think we do, but as you know, I mean, nobody really wants the government to be that in control of sending our money. I mean, that's why Bitcoin's on a rise. We don't want the government to have that biggest control over us. So, but probably a decade to 15 years out is where they're looking. I mean,
I hope you're right. I think it's going to be sooner, but I hope you're right.
Not everybody even has same day ACH. The Fed is still so far behind on that. I mean, it is just right. And, with all the consumer protection laws, those end up being more of a deterrence, and that hurt. I mean, I'm a little bit of a libertarian at heart. I love the fact that I could transact and, send currency to you without having an intermediary. And if I was being a merchant and not having to worry about chargeback rights, right, that's wonderful. Because all day what we see, we primarily a business bank. Majority of our customers are business accounts, and we're able to cater to them. And like I said, boutiques, so we can provide them services. We're not planning on growing on the mass scale for consumers, because with that, I mean, daily you'll see consumers, I didn't make that transaction. Now, there's a good percentage of those that they did make that transaction. They just have buyer's remorse, and it's the easiest thing they can do. They know they're going to get provisional credit, and it may be a small amount where we end up eating the cost. So, right, the fact that whether these transactions, these cards, they go in the Lightning Network or any of that, that's why I would really love to see that, because we don't make money off of debit cards. You have to do it at such a large volume. The only ones that make money are the networks, and they profit every time there's fraud and every time there's not on both sides. So, I mean, I love to see those networks really get obliterated.
Yeah, no, that's a interesting comment and perspective. You kind of answered this. I'm going to restate it, then go on to my question. But what I just mentioned, inevitably, central bank digital currencies, them dealing more direct with the consumer, savings and checking not being as needed anymore, that coupled with Voyager, eventually Coinbase and other platforms doing lending on crypto that's paying a lot more, decentralized finance and staking that's occurring on there. It almost makes me wonder how small banks are really going to be able to compete. Now, you mentioned with service and other ways, at least until this all becomes more popular, you're probably true or probably correct in the relatively short term, but that does segue pretty well into the next series of questions. You have been more creative than most people in your role in terms of looking at things like cannabis and crypto. We don't appear so close to cannabis being federally legal. However, do you see banks being involved in the industry? Is it through the don't touch the plant? Where are the opportunities, and is there some risk?
There's always going to be risk, but where it is you've got some guidance from regulatory agencies that say if you are going to bank it, here are the following that you need to do. So with us having a huge background, and I've got a third of my staff that is just dedicated to the Bank Secrecy Act, looking at transactions, looking for suspicious activity, filing SARs, filing CTRs. So we were already built up for that to be able to take those services. But, the genie's out of the bottle.
Yes.
It's happening in every state. You've got publicly traded companies now that predominantly a lot of their money touches the cannabis industry, whether it's in lighting, irrigation, and the real estate that they combine. And so much of it is going to touch it. What we can't have is this industry in Florida pile up with millions of dollars of cash just sitting in there, not being able to go to the government. So the states want it here in Florida. They want it to be banked. Colorado, all of the states that have voted in, they need them to be banked.
For sure. There's tremendous opportunity there. It gets a little complicated with the federal aspect, and maybe that's where the opportunity lies. It is complicated. It's tricky. The big banks are obviously not truly going to be involved, and that may create opportunities for banks that are more local and regional. We'll see.
I mean, it's not one thing that we're going to ever become dependent on it. And
Right.
when you are going to bank that industry, you need to come from it from a position of strength and not, oh, this is our Hail Mary to save the bank. That's
Yeah,
a
that would
bad
probably
position to be in.
Crypto is not federally illegal like cannabis is. However, why do certain banks even now close accounts? I have one of my members who had $1 million closed down because of a big movement from crypto. There are banks that still aren't comfortable with this.
No, I mean, because the regulators have scared them. If we saw a customer that wiring out $1 million to an exchange, say, Angelo, hi, I see this wire. You're at an exchange. What are you doing? Your customer. So that's a 2-minute conversation that we've identified, and we have a reasonable belief that Angelo made the money legitimately and they're investing their money in crypto. There is nothing wrong with that. But when regulators come in and audit, they want to know when they see wires exchanges that the bank has a reason and has an answer to why that transaction was done. So you really have to have sophisticated BSA software to be able to set tailored alerts. And majority of the banks have, like I say, canned white label BSA system that is based on consumer accounts. So they just, oh, I don't understand the blockchain ledger, so I don't want to do it. So they just push it aside and that's it. Meanwhile, with them not knowing that, it's still happening through their institutions. They're just now unwitting participants.
Kind of a twofold question. It may get a chuckle, then we'll try to give it an answer from your perspective. Is Bitcoin a threat to traditional banking and to the US dollar? Its dominance, at least.
Yeah, yes and no. I could go either way on it, but I think it's got to push the American dollar. It's going to make the government innovate a lot faster. And a lot of people, old timers in the U.S., they see Bitcoin, they say, I don't understand the need for it. Well, they don't live in Venezuela where the price of bread goes up while they're waiting in line. So Bitcoin is across the whole world. So just because they didn't see it in their corner of the U.S. didn't mean it was very relevant in other parts of the world that are needed. With El Salvador making it, it's their currency. So, yes, in some aspects a threat, but I think it's just going to spur innovation.
I agree. I am going to read a quote from Thomas Honig. Hopefully I'm pronouncing that right. Here it goes. The advent of digital currencies may allow people and businesses to get around banks, says Thomas Honig. Who is he? Well, he's pretty important. Former president of the Federal Reserve Bank of Kansas City. He goes on to state, if cryptos become a substitute for the dollar, they could create a separate money environment that can make monetary policies more difficult to implement. He's technically right.
Yeah.
But I'm wondering, is that such a bad thing?
Could the safety, let alone with, you do have some comfort in the bank. You've got that wall. Your money is at the bank. It is insured, so as long as you're under that insured limit, if that bank was to be taken out or all the money was to be hacked and removed, your money's safe. So you have that safety aspect, but ultimately the government too wants to, keep an eye on terrorism activity, money laundering. So, they're going to need it monitored. They're going to have some expectation of where these exchanges are going, who's being monitored, and the identification of these wallets.
Which is happening as we talk. I mean, since crypto really started to take off, basically pretty early into COVID, so let's call it 14, 18 months, it's gotten a lot more attention from all sorts of perspectives, including regulatory. Yeah. Now, I will add, banks like Goldman and JP Morgan have significant teams dedicated to crypto and digital. It's on the Chicago Mercantile Exchange as a future. U.S. Senator Loomis is very vocal in Wyoming as an advocate and a holder of crypto, other U.S. politicians. What I'm basically trying to say is it's not going to go away. Now, the government may one day want to consider it as a property like real estate and tax it annually and make a lot of money. Oh, I could see that happening. I mean, I could go on and on about this subject. I am 99.9% sure it's not going to go away. It also has pretty powerful political influence now. Tens of millions of people in the US own it, transact in it. So to stifle it, to cripple it, probably would have been possible a couple of years ago. I think it would be very hard now. But to think, like you said, that it's completely anonymous relative to the know your customer rules at exchanges, relative to the power and capability and technical proficiency of the government. Now, we laugh at them as being slow and not quick at adapting. They have some amazingly smart and talented people, and they could hire the best technologists in the world and pay them anything. It's probably, I don't want to get, it scares people when I talk too much about what they could track. So I'm not going to get too crazy on it. But to think that if you're someone of great wealth or someone known, that you're not being tracked and monitored, you are, I was going to use a swear word, you are absolutely kidding yourself. Now, the average Joe may be able to be under the radar. You're not as important enough to the government. But if they want to make a case of you, or you're a larger relationship and you're doing something funky, they will find out about you and you will get caught.
Absolutely. I mean, it may get to the point where people are going to have where banks are hosting the wallets. I mean, I can see that.
Right. I can see that too, potentially. As scary as that might be for some of my maximalist friends out there, I agree. Bitcoin and crypto is going to be here to stay. There'll be winners, there'll be losers. But to think that it's going to go quasi Wild West unabated, although I may want that, that's just the reality is that's just not going to happen. We just have to be realistic. You mentioned it a little while ago. Bitcoin has recently become legal tender in El Salvador. I could argue a little quicker than maybe it should, and with more, it probably could have used a little bit more work behind it, but we could save that for a different time. I guess it's inevitable. Other countries like that may start to do so. Do you think they will? Do you think in 2022 we'll see other countries, if not even by the end of this year?
For sure, you're going to see countries that have minimal GDP. They're going to go to that. It's probably save them a lot of time and effort by going to Bitcoin as their legal tender.
And by the way, I'm very interested in that. I'm generally an advocate, although with some concerns, although I am more active in other aspects of the digital asset community. You would think that happening and talk of others, that the price would begin to explode even more. And there obviously is hedge funds in the markets, manipulating the markets. You're foolish if you don't think so. And eventually institutional investors, the issue about clean energy or green is going to be a bit of an issue with them. But let's just say more than a year or 2 years ago, there's some activity with them in Bitcoin. That being said, even with the news of El Salvador and potentially other countries, it hasn't like popped. It's down the last couple of days from 52 to about 45,000. I'm putting on your investment analyst hat on Bitcoin. What do you think?
You know, I'm like I said, we're expert in anti-money laundering policies and banking. So as for the future of the price of Bitcoin, I mean, I love the fact that there's only so many defined amount, 21 million Bitcoins. You've got a scarcity. You've got that. I mean, yeah, it's going to ebb and flow up and down, but ultimately, I think over the next 10 years, it'll outperform our stock markets.
Yes, and I'm more optimistic potentially about other cryptocurrencies, and I'll save that for a different time. I was going to say something. I'm going to keep my mouth quiet. I'll probably get banned on YouTube. So I'll be quiet about that. We'll save that one for a different time. I'm going to read a comment, then make it a question for you. Okay. Capital is flooding into companies that are building everything from trading platforms, exchanges for trading new digital assets like non-fungible tokens, aka NFTs. Investors are also trading tokens on decentralized exchanges like Uniswap. I know, I've done it. And they're earning high yields by staking, a phrase I used earlier, their tokens to network operators. I kind of asked this question, but now it's being a little more formalized. How will your bank and others be active in this? And it just sounds like laborious, intensive, a lot of talent internally needed, and maybe a truckload of regulation. It seems hard.
Well, you know, the one thing, all fintechs, they end up having a relationship with banks. So there's always the opportunity to be looking at companies that are in that sector that, the big banks aren't going to give them the time of day. Or, a lot of times when I see a big bank and their teams, they're not in the weeds understanding everything. They're just paying somebody that came from Ivy League and think they know that. But how often is it really coming from there? I mean, it's usually somebody that's in the weeds that is dealing with it. So there are going to be plenty of fintechs that can partner with community banks and grow that. But then it's going to come into the regulatory framework of how friendly the regulators are going to allow us to explore in that realm. But yes, I'm early stages. I'm fascinated by it and the NFTs. And so I'm just early on, learning all that I can.
How could I phrase this question? You're younger, you're notably younger than me. So you're kind of getting it for someone in banking about the future, central bank digital currencies, fintech. We got other things to talk about soon, Bitcoin, crypto, and digital. But you have shareholders, you have board members, and you have the conferences and things that you go to with bank executives. You're still, even after 12 years, probably one of the younger ones. When you hear the traditionalists in your community talk about, I mean, they probably barely know Bitcoin at the moment, maybe a little bit of Ethereum. They're going to have no idea about things like Solana, EOS, the graph, and other things happening. How do you show respect and homage to their experiences and what they've done, but also maybe say like, wow, they got their head in the sand about these issues and they're going to be wrong about a lot of it?
They don't have to understand the whole technology.
I agree.
You have to know the fact that it is leading that way, whether you agree with it or not. You've got to understand that. There are some banks out there and community banks that are looking into that. But when you go to a bank conference, majority of them, they want to sell. They want to go out. And they just want to sell to another bank. That's what it is. When I started in Florida, we had, 350 banks or so headquartered in Florida. Now we got under 100. And, now you're seeing banks sell to credit unions. So they're either just wanting to sell or they're complaining about the credit unions. That's the two things that you hear at the banking conferences. So for like innovation, that is not where I go for anything as a banking conference, because it's the least innovative thing you ever see in your life.
It's asking you to put on your analyst hat again, so it's unfair to you.
Yeah, they're not for them, and they're all wonderful, great people.
Absolutely.
They love lending. They see that, but even like, nowadays the new buildings, so much of it has gone to like franchises or what's building. So I mean, you don't see as many mom and pop locations just being built like you did prior. So a lot of the construction, a lot of things they're doing are, large franchises that I see around. So a lot of that is kind of going to the wayside.
I mean, there are, in Wyoming, I believe there's several, maybe some other states. It's been a very creative, just like Wyoming and South Dakota were at the forefront decades ago in LLCs. They've been as such in crypto. So there's crypto-centric banks and what's called DAOs, DAOs in Wyoming. And I don't know if you're too.
I'm not familiar with that. No.
And I don't blame you, but it's probably something that you should look up. It's very intriguing. How will banking more broadly get involved in crypto, such as lending against crypto, staking that I mentioned earlier on DeFi, securing, storage? A lot of people aren't going to feel comfortable putting 6 figures on a wallet and being subject to a cybersecurity hack. They may want custodial solutions. I could guarantee you within the coming months, we're going to hear about Goldman, JP Morgan, and these big banks that said one thing 2 or 3 years ago and were very aggressively working behind the scenes doing another.
Oh, yeah. I mean, you're seeing some banks where the consumer accounts, you use a debit card, a percentage of that revenue will go to a hosted wallet that's a third party doing that. But where I see banks are doing it wrong is we're the ones at risk. We're the ones the regulators come to. We're the ones that have capital. And what I don't want to see are the banks giving away the farm as far as the transactions. There's a lot of money being made on these transactions, and the banks need to make sure they get their fair cut, because a lot of times they're just giving away the sun on that, and they need to be more in control over it. They need to understand it. The regulatory framework needs to encourage the bankers to learn it. And if they make one little mistake, that it is not, you're done, Monday morning quarterback out there. So the regulators need to work more with the banks in regards to that, because yes, I would love to, just because of our size, if my Atlanta regional office was watching this podcast and see that I'm loaning against crypto, I guarantee you I would have examiners here in 2 weeks. I actually had that. They had heard that an interview I had where we were launching a gift card. In 3 weeks, I had a dozen examiners here.
I can only imagine what this interview is going to do to you.
It was amazing. I called him. I said, "Why didn't you call me? There's only $8,000 on deposit for this. Like, this is such a small little thing." I'm like, a phone call could have handled this. But yeah, there was a side, and I had to get on the horn of the attorney, and went through and everything was fine. But yeah, they want us to tell them everything up ahead of time. Happy to do, but when you do, you get nothing. All they want to do is send examiners, and they want to get you for minute. They won't say don't do this. They'll try to hit you on like a UDAP thing or just something so minuscule, but want to drive your staff so insane that you say, you know what, it's not worth it. The aggravation.
Yeah, there's almost, well, here I go again. The big banks have a tremendous advantage. They have internal resources, they have people, they have a lot of money. Let's be honest, very powerful political and internal clout. Actually, some of the banks I mentioned, well, hello, they're among the 12 banks that make up the Fed. Oh, we're going to get to some of that shortly, and I'll try to be nice about it. So we shall see. But what I'm just talking about with crypto, with stable coins that I didn't really mention yet, and NFTs, I mean, many banks and financial companies, my God, including Visa, who's buying Bored Ape Yacht Club NFTs. If you're not following NFTs, you're going to have no idea what I'm talking about. And that is now worth a gazillions more than what they paid for it. But JP Morgan, they're all working on integrating crypto, stable coins. And here's the key part. Hello, they're aiming to capture the fees on brokerage, custodial, and payment services. And I don't blame them. I think that likely is the right move. But I go back to a question that I kind of asked before. How are you going to keep up with this?
That's the saying. There's always going to be boutique and small sections. I don't need to be Visa. Don't do that. You find your niche community and you serve them well. And so that's what we're doing. And that was one thing I took off of the big banks. I remember seeing 20 years ago that majority of their income was fee driven as opposed to loan driven. And when I was in the bank was, wait a second, all of our income is interest driven from loans. But when you have a commercial real estate collapse, that goes away pretty quickly. So I knew that we had to be driven from other types of fees. So, I see that. I took a note from them. They definitely know what they're doing. They're making a ton of money off of the payments industry. All the check networks are owned by the big banks. So they may make a penny on every check that's written in the world or electronically transferred. So they know that game.
This may be more applicable to my live audience, but even if you're watching this on the video, you'll be able to either probably see it on my YouTube platform as well. As you can probably tell, I'm really intrigued by banks. I'm especially intrigued by the international picture and how this is going to play out with central bank digital currencies. I'm thinking about inflation. I'm thinking about all the things out there that impact those as an investor. And yes, definitely the crypto and the decentralized finance, NFTs, and all that. I have multiple interviews coming up on these subjects, one with more of a conspiracy theorist than me. He's based in Europe. He's coming up next week about the Iceland crisis, a little bit about Switzerland. We're going to go deep into central banks, the Bank of International Settlements, the BIS in Switzerland, lots of juicy stuff there. And cashless society, Richard Turin, he's coming on in 2 weeks as well. We're going to do a deep dive 2-hour interview with him. He's a very smart American living in Shanghai and really tremendous insight into China's central bank digital currency. His book is, I believe, currently a New York Times bestseller. And he knows I'm going to go really deep and hard with him for 2 hours. And he said, bring it on. So hopefully you all will enjoy that as well. A little bit related to some of that, Ryan, and hopefully not too uncomfortable of a subject. Tell us a little bit about the Fed. So a lot of people don't realize, so that's our central bank. we all think that central banks are completely owned and governed by governments. And that's usually true, although not all the times true. And it happens to be only limitedly true with regulatory here in the US, the Fed, our central bank. It's governed by whatever the board of governors, by the director, by the government, but the actual equity owners are 12 banks. They appear to be a little private in terms of who they are, but with a little research, you could figure it out. It's often the big players. Some of them are public companies. I guess most of them. So they have shareholders. They're interested in short-term benefits, and some shareholders are highly powerful and influential and are not even US citizens. So I don't know if you really want to dive into the subject, but tell us a little bit about the Fed and the interaction. For you as a small community bank, I'm assuming it's not much.
So yeah, I can only tell you our interaction, but wires go through the Fed, ACH is cleared through there, checks cleared through there. So you have your protocol, whether it's a late day return, a bounce. So there is good protocol in regards to paying bank, receiving banks in that aspect. So, usually depository banks, if there's a bad issue of a check, end up cutting it. So you've got that. And also we can buy into the Fed as well, buy stock into it. And the Federal Home Loan Bank of Atlanta, we can put up our loan portfolio and use loans as liquidity in time of need too.
Right.
So that's other aspects. So that's a good yield for us if we've got large demand for loans and liquidity is getting tight. Borrow from the Fed for temporary. You don't like to keep it out there for long, but you can borrow for years. And you look at it. Is it a cheaper rate than it is paying higher on CD rates or different things? So it is very helpful for community banks to be able to have that relationship.
And in terms of regulators for the community bank, I'm assuming the FDIC, the OCC, and how does the CRA, the Community Reinvestment Act, even play into community banks?
So, we're state charters in Florida. So we have the Florida Office of Financial Regulation is where our charter is held. And then the FDIC is our major auditor. So, they come and audit us minimum every 18 months for safety and soundness exam. And you have a compliance exam as long as you're doing well every 3 years. And that's FDIC, and they come in and look at CRA. Now, when you're a smaller bank, you need to make sure that you're, somebody with less means, but normal credit, you're providing the same amount of loans as you would somebody else. And also when you designate a certain area, when you've got applicants in that area, that you are dealing everybody fairly, which is a great thing. So CR is great. Now you're definitely held to a much higher standard the larger you are. So, which is good because you don't want a large bank, Bank of America, to be the only bank within 100 miles and they decide to close it down. So they would have to be, get approval to shut down a location, make sure they're not creating a famine for banks in that area.
For sure. Where do you see interest rates heading through the end of this year and possibly into next year? I know not your wheelhouse, but if you have an opinion,
So, the last banking economist I saw there, I totally disagreed that inflation was all transitory. Yes, some aspects of wood be a little transitory, lumber, but in general, when you're seeing restaurants and fast food as they've raised their prices, they're not going to lower back down to where they were. So, I see that growing. The Fed, I think they need to raise rates, but I'm sure they're afraid at the same time. So I think they may start raising the rates a little bit at the end of the year. But, when I started in banking in 2001, we were paying 6% on CDs. And so you could have a retired couple living off of Social Security and a couple $100,000 in savings, and they could make do. Nowadays, with this low rate environment, it just incentivizes savers. So, $1 million, you're retired, have your house free and clear in $1 million, you're not making enough in a bank and a savings account to cover your costs like you could 15, 20 years ago.
And a little bit of a different direction, but I'm thinking about some of the things I mentioned earlier and still to come and how advanced they are in China. We'll get to some of that stuff shortly. And I'm thinking about some iconic companies, I think US-centric, Western Union, MoneyGram, et cetera, definitely hardcore middle man, middle person organizations. When I think about central bank digital currencies, about the advent of US technology companies getting involved in the space, we'll jump into that shortly. I don't know if I see a great future for those organizations, but maybe they'll adapt and there'll be something for them.
Yeah, I didn't see a question in there.
Yeah, I mean, I look at things like Bitcoin and cryptocurrencies.
I mean, they really have. I would think would take a big bite out of the Western Unions and the MoneyGrams and the transfers. Right. Now, I'm sure there'll be some segmented ones that people are used to, and I think for the most part, a lot of that industry too are creatures of habit. So it may take more time for the change. And if you grew up going to the convenience store and on payday getting Western Union sending money back home, you're going to continue doing that for a long time. So I'm sure you'll see the Western Unions and the MoneyGrams evolve and start changing their protocols. Maybe instead of using their own network, maybe they'll be cutting costs and hopping on the Lightning Network,
True. And just so I could have a chance to look at some of the questions I have remaining and gauge our time, we're 3:07 Eastern time. Do you have 10 minutes or to the bottom of the hour at 3:30?
I got plenty of time.
Okay, let's do it. I'm going to actually read a little bit from a blog you wrote. I actually went on your site and looked at it, and it relates to cyber issues that we spoke about earlier, but we'll tie in crypto. So Ryan's also a great writer. At the end, we'll talk about where you could learn more about the bank and access his blogs and all that. I'll read a little part of it, or one of them. A recent hack of the Colonial Pipeline, which stretches 5,500 miles from Texas to New York, brought to light once again the vulnerability of our systems to international hackers. In this case, a group called DarkSide claimed responsibility for the attack, using ransomware to steal large amounts of data and hold the entire pipeline hostage. They were paid off via crypto, I guess Bitcoin. And boy, very, very quickly did the US government really get to the bottom of that for the most part, which could lead a whole other series of questions about how anonymous it really is when the government puts all their resources behind really looking into something. There's other comments I could say that I'm not. My bigger picture question to you is I agree, those are concerning. And the bigger picture question is banks must have tremendous risk of cyber attacks by nation states, by hacking groups like DarkSide that I noted. For bigger banks, this is a tremendous challenge. For community banks, this could be a wicked challenge. How are you addressing that?
So, yeah, and I don't believe like that hack. I mean, they weren't a huge company. I mean, they're pretty large, but it doesn't matter what size you are bank, we have to have strong security as the big guys. And we're only as strong as our weakest links. So we have to go out there and look at class vendors and see what they're doing. And so the biggest thing for banks is what regulators now hit upon is vendor assessment. So we really have to pay attention to our vendors, look at their reports, look at their audits, and come to a great reasonable belief that you've got some faith in these vendors to hold our security to do that. And so, we just had a cybersecurity threat walkthrough. You've got to have a plan of what you're going to do, because it's not if you're going to get hacked, it's almost when you're going to get hacked.
Yep.
So you've got to look at it from that point. We're consistently sending out emails to our employees to try to have them click on a fake phishing campaign and go from there. So we're doing everything we can as far as enlisting that, training our employees, getting our data out into a private secured cloud, and even if I'm not expert in security, just always ask that question: what is the most secure we can do? What does that cost? Where is this? And just keep falling down the line. So it's getting good, reliable vendors that you have got a reasonable belief and trust in. And never assume that you're perfect, because really there's no one's perfect.
I'm going to do a little reading, then I'll phrase it into a question. This from Richard Turin's book, and again, he's coming on as a guest the cashless society relatively shortly. The digital RMB, I guess the Chinese central bank digital currency, is radically different. It relies on a new and separate system of monetary transfer independent of Western financial networks and its rules and regulations. It offers a different network, a new type of currency, and more importantly, new possibilities unhampered by entrenched regulation. So with China going digital, there's a sense that big tech is fundamentally different there than its Western counterparts. You look at Alibaba, WeChat and those, I mean, they're really involved in the financial network of China, in many ways bypassing the banks, for lack of a better word, much more so than Square and PayPal and others that we have here in the US. Now, the question, banks in the West, here in the US primarily, are licking their wounds from the financial crisis, yet they feel so smug and secure, they're too big to fail, that digital technology is not really considered a threat, despite the explosion of even services here in the US that show how industries can be disrupted. Look at Airbnb and look at Uber. Big banks have gotten very, very smug and arrogant and have not really kept pace with a lot of the things I'm seeing in other parts of the world, mainly in Asia. Speaking strictly from as an American perspective, yet having insight into fintech and banking, should we be concerned about this? Even though that may be somewhat of a threat to some of the things you do in community banks, you want America to win.
Absolutely. I think the biggest thing that has been hit in the fintech is, the customer facing, the ease of opening an account, the ease of these things. And really, I think the operations on the backside needs the greatest innovation. And that's where you have the Stripes come along and have the amazing payment portals to be able to put on the websites. And so you've had a lot of innovations in that area, but the operations at the back end, I believe, really need to be now focused on and grown. Still, doesn't matter how great customer facing stuff is, the whole banking, there's still a lot of rudimentary paper moving in the back end with the payment system. So, operation wise needs to increase.
Yeah, I mean, I look at Ant Financial in China. I think you could do, their version of a money market account there for as little as 15 cents. It's just so efficient and cost effective. They could actually do it for something as nominal as that. And that brings up perhaps my question to you is, what I see in China has reached the unbanked, the masses, the below middle class. There's financial inclusion via China's massive population, many that were long since passed over by traditional banks. I know that you think of that issue with the unbanked as well. And that potentially is the promise of Bitcoin, other cryptocurrencies, and some of the advancements that I'm seeing in China that is going to be good for those, arguably, that are the unbanked, that are the lower economic stratosphere, that are often ignored by Western banks and financial institutions.
Yeah, I was listening to an interview, I think earlier today, and that was the thing that really, enlightened me to the promise of Bitcoin, the Lightning networks, of being able to make a transaction and pay someone 10 cents. And if the banks and everybody else didn't have that large per cost per item thing, I think that would create more value for businesses. And I think the example was, there's plenty of articles. I don't subscribe to the New York Times, but there's occasionally I want to read an article there. Well, I don't want to put in my name and email and sign up for that weekly free thing. But if you have 15 cents to read that one article, boom, I would pay that immediately. And so it would be amazing to be able to have that level of being able to pay. I think that would make, it adds so much more valuable to those companies that you didn't have to add that large subscription that you could do per item basis. And then the bank could actually not get hurt on that transaction either. It wouldn't cost them the same amount of percentage if they paid it.
Very true. I mean,
it's like the government mailing you a 49 cents rebate check. Thank you. It costs way more than that 49 cents to send it.
We are way behind here. Not in terms of timing on the podcast, in terms of from a fintech and banking and central bank digital currency perspective to what I see happening in China. Relative to that, EY had a study global fintech adoption showing kind of a disturbing trend in the West. Basically, China and India were tied at 87%, which is incredibly high as per populace, while the US's score was about 46%, which ranks 24th. 24th. I mean, basically what I'm getting at, exactly what you said, and what I'm seeing using, and China has many, many things that are of grave concern to me, which is why I'm concerned. But in certain aspects, in AI, in banking, in fintech, they are so far ahead of us that I actually don't know if it's even going to be possible to catch up at the moment. Again, I'm putting you in a tough spot on this question, since to some degree, and I mean this respectably, you are a part of the establishment with a U.S. bank, although a nimble community bank at that. And I don't know how much you've studied some of the things happening in China and even broadly in Southeast Asia and Singapore, but it's a lot different there.
Yeah, I mean, and we're located in DeLand, Florida, which is just west of Daytona Beach, in between Orlando and DeLand. So we got I love it here. We got the beaches close by, the city of Orlando, and, we still got agriculture around here. So I still have customers that they have such a large distrust for government establishment that they will never buy Bitcoin, that they're just happy to go buy gold and keep their gold in their safe at their house. And so, you've got a huge population of the US and rural America that are doing that and are not going to adopt those technologies. I see that more in the outskirts than they do in the cities. But, I think we've got that embedded in our culture, and it'll be many years, and you're not going to change those minds of those individuals.
What I will say a little bit about that, to their positive end, many of them are libertarian points of view, something I could understand and relate to. And as they've gotten more comfortable with things like Bitcoin and cryptocurrencies, especially if they're under 50, they have adapted. They look at simply from an investing perspective relative to gold, it's done much better, and it's far more portable than gold could be. Now, again, and I like gold too, but we could go into the arguments of that. But I actually think a lot of those people that you're noting in rural America are actually a little sharper onto technology and some of the things I'm talking about. They may need to be a little bit on the younger side, I hear you, but I actually think a lot of it is starting to soak in. On that same subject, and again, this could be a sensitive subject for you, Google, Amazon, Facebook, Apple, iconic American companies. Actually, I think I just named 4 of the 5 biggest companies on earth. They could do some of the things that I'm mentioning that's happening in China. They already have our big data. We already use Apple Pay, and Apple knows where the hell we're going, what we're doing. I don't really like it either, but for us to keep pace, why don't we take the gloves off those companies and have them be more active in fintech and banking, because maybe they could do a better job of it.
As long as they're held to the same regulatory scrutiny that we are, I'm all for it. And they do. I mean, they've already got the price points Amazon could do if you had Amazon Bank would be unbelievable. I mean, you're going to have a massive adoption. Everybody would have an Amazon checking account. And that's the kind of thing, like, so many banks, what makes Surety Bank different than this bank? I mean, in essence, we're all selling the same product. I mean, it really is. So what differentiates? Now you're seeing a lot of niche banks that are, coming out, whether it's Chime and, coming out there. So yes, Amazon Bank, should they be involved in that? At some point, there needs to be a combination. They need to work with some existing bankers and combine it too, because they definitely are not held to the regulatory standpoints that we are, for sure. But I mean, that is a big threat. That would take consumer accounts from the big major banks in a heartbeat.
For sure.
It would, like I say, a lot of our customers are larger businesses that need our services, and we cater to them in boutiques. So it wouldn't make a direct impact to us. But, there also could be sharing, as far as you have the Amazon Bank, and those deposits could be on the rails of thousands of banks.
And yes, someone sent in a text, the money, and I'm using things in China like WeChat Pay that I noted and Alipay platforms. They do have a phrase for it. It's called super apps. And I did forget to mention that for those of you that are students of fintech in China and some of the challenges that are happening around the world relative to central bank digital currencies and the kind of what led to it, kind of the first stage. It would be good to get the vocabulary, I guess you could say, correct. I read this, so it's not an original quote from me, although I do like to pull those out sometimes. Most of us don't wake up in the morning and say, oh boy, I want to go visit my bank and see what's up. Instead, they use it to buy a house or to send money. The bank is a means to an end. As a community bank, with all the things we discussed today and all the changes on the horizon, how do you still have that personal touch where maybe actually occasionally people do want to stop in the bank. They do want a brick and mortar. They do want to have someone they could talk to that's not AI or automated. And again, you're competing, and one day maybe competing against the Apples of the world. You need to have that personal touch. Maybe people are willing to pay a little more for that.
It still is in the back of consumers' minds that if there is an issue, okay, I have a location that I can go to. And now with the big banks, okay, you go to those locations, you're not going to get any better than calling online because nobody at those branches can help you with anything. You're not going to have, they're just going to say, here, call that helpline. You're going to have to dispute this charge this way. It's kind of gone to that ways. So you do find even a younger 20-something years old, if they're thinking of starting a business, you will get them to want that face-to-face interaction. And, so there will always be a place for that. But for the most part, you'll see somebody if they're opening up a new account. And then, the good customers, when I say good, ones that, balances are there, they're not overdrafting their accounts, you hardly ever see them. So you got to make it a point to almost reach out to them and say, hey, we're here if you ever need anything. What I don't like to do is oversell customers, because I hated that when I used to go to a big bank branch and you're in line to withdraw money and then they try to sell you 15 other products in your line.
Yeah, you're trying to get out. That's happened to all of us.
Yeah, so I hate that. But for the most part, who you see an average are the cash businesses that, they still deal with cash in the registers and they need to make that exchanges back and forth. That's mostly who you see on the day-to-day.
Yeah, I see something came in through a text tonight from one of my live listeners that still likes to send things through text, and that's okay. I don't mind that. It's interesting, and we have spoken about this before with some of the things I mentioned that's happening on the advancement in fintech and central bank digital currencies. Correct. Facebook, with its Diem Libra, did try to go down some of that path. Now, again, it doesn't have great trust among the public, and I think Mark Zuckerberg may be, along with some others like Elon, the greatest entrepreneur on earth. And if it wasn't for the constraints that he has buying other companies, I think they would be completely dominant and he would be the richest person on earth. So I have great respect for what he's accomplished. And I'm also from Westchester County like he is. So a little bit of love there. But yeah, I don't know how closely you followed that Diem Libra and what Facebook was looking to do. We didn't talk too much about stable coins. It came up a little bit today, but this all interplays to our discussion.
No, I did follow when I was very excited when they announced Libra went in there, and it fizzled out pretty quickly from there. So
yeah, the government didn't like it. They told them to stop.
So it was interesting, and so yes, it is kind of scary from that side. I mean, if all your transactions are made through Facebook Marketplace, now they're handling your money back and forth. Yeah, that seems like you're giving a lot of control into one company. I see that, but then again, on the flip side, are they going to give you the best experience at the best cost, and are they better? I don't know. I always like competition. I think brings out the best for sure. But
indeed, and I think this is a good question. Buy now, pay later. Is this a threat to community banks? And you see this happening.
I think that's a threat to our society. Why are you buying that now and paying later? You shouldn't do that. I mean, that's, the whole thing's with rates. Banks work on margins. So if the Fed, increases the rate, now it's at a 0 to 0.25%, but they equate, 2%. We're going to work off that margin. We will be fine. We'll figure it out. Maybe in the beginning you have a little bit of compression and your loans didn't reprice enough up, but we'll be fine. But what we've done is really hurt every senior citizen out there that can't live off their savings. They're having to pull their money out of their pensions. They're having to pull everything out of their savings and use it. So it's horrible, this low interest rate environment. You should not buy that product if you can't pay for it, flat out.
I think that's good old advice that we can all listen more to.
I mean, I did a little residential lending in my beginning, but I hated it because you would have husband and wife in there. They would say, how much house can I afford? And you're like, well, you can't afford this, but listen, you shouldn't buy that.
Yeah.
So it's the worst thing. Everybody has to live somewhere. So they put too much value on the worth of their house. It doesn't matter if you live in a $500,000, $100,000 house or $2 million house, you have to live somewhere. And if you sell that, you're going to buy the same thing elsewhere. All you did was, lose money in the transaction cost. So I hated that aspect of residential lending. I'm definitely not a salesperson. I wasn't going to convince them to buy more of a larger house. That's why I love commercial lending. If you come to me for a commercial loan, Angelo, if you're not going to make more money by borrowing that money, then I'm going to tell you, even if you can afford it now, you shouldn't do it.
Yeah, that's the right attitude to take. And it's been a pleasure to have you on. Like I said, I've have been offered opportunities to have other bank CEOs on. And sometimes I send them a list because they requested 15, 20 of my advanced questions, and they cross out about 3/4 of them. And after doing this interview, you probably know why they probably did that. They might have been correct, but it doesn't create a good conversation because it's very sterile. And some of the questions I brought up are not black and white. They're gray. They're complex. We don't know how this is going to play out. It gets complicated, and to share opinions that are more than 2 + 2 = 4, completely factual, is very hard apparently for some people to do. But I do understand with the regulatory oversight, and a lot of them, their age and their mindset just may not be open to some of the things that I mentioned. For those that would like to learn more about you and Surety Bank, and maybe even like I went to your blogs to learn more about that, what website could they do and how could they access and learn more?
Yeah, I mean, we're looking at mysuretybank.com, and then I've got a personal website at ryangjames.com.
And if you could say that again, just for those that maybe missed it.
mysuretybank.com is the bank's website. We've got an About Me section, and then I've got a personal website, which is Ryan G, as in George, James.com.
Great. And our special guest today was Ryan James, spelled as you would expect it to be spelled. Ryan James, CEO of Surety Bank. We greatly appreciate his time. For those that may be more active allocators and investors, and again, I'm not really sure that you're looking to grow or need additional shareholders or outside capital, but is there a way that people can maybe, if they wanted to directly connect with you on that they could do so?
I'm also on LinkedIn. Feel free to
that's a good
LinkedIn. But like I said, we're subchapter S. We got less than 30 shareholders, from here. And at some point, we'll probably look to doing an offering to increase value, but, growth. But at this time, we're comfortable at our level, and we've got left on our runway.
Well, thank you so much, Ryan. I really enjoyed our near hour-and-a-half discussion today. We covered a lot of ground. Again, this has been a subject of interest to me and one that we'll be doing more of, and it was really exciting. For those of you that were live, thank you for your participation today. Those of you that will listen or watch this, we hope you enjoy it. I'm Angelo Robles, the founder and CEO at Family Office Association, a global membership organization dedicated to highly successful families and their family offices. Go to our website. Simply, it's our name, familyofficeassociation.com, and learn more. And maybe you want to join. I'm also the host, as many of you know me by, as the Angelo Robles podcast. My actual podcast itself go up some of the interviews I do on Apple and Spotify, but we're much, much more active on our YouTube platform, which simply is Family Office, or put in my name, you'll find it. Anyhow, thank you all for our live audience. Ryan, again, thank you for being a great guest. And those that watch or listen, we hope you enjoyed it. I'm Angelo Robles. Have a great day. Thank you.